Gentlemen, good day and welcome to the Innova Captab Limited Q3 FY2024 earnings conference call hosted by JM Financial. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amey Chalke from JM Financial. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and welcome to the first result conference call of Innova Captab Limited. Joining us today on the call are Mr. Vinay Lohariwala, Managing Director, Mr. Gaurav Srivastava, Chief Financial Officer, Mr. Lokesh Bhasin, Deputy Chief Financial Officer. I would like to now hand over call to Mr. Vinay Lohariwala for his opening remarks. Thank you, and over to you, sir.
Thank you, everyone. Good morning, everyone, and thank you for joining on our first ever earnings conference call to discuss the operational and financial performance for Q3 and 9-month FY24. On this call, we are joined by Mr. Gaurav Srivastava, CFO, Mr. Lokesh Bhasin, Deputy CFO, and SGA, our Investor Relations Advisor. I hope everyone has had an opportunity to go through the financial results and investor presentation, which has been uploaded on the stock exchange and on our company's website. This quarter has been monumental for the company due to its listing on the stock exchange. We would like to thank all our shareholders and other market participants for their support. As some of you may be hearing us for the first time today, let me give you a brief overview of our company, and then Mr. Gaurav will take you through the operational and financial performance. About Innova Captab. Innova Captab is an integrated pharmaceutical company in India with a presence across the pharmaceutical value chain, including R&D, manufacturing, drug distribution, and marketing and export. Our journey started in 2006 with a plant in Baddi, Himachal Pradesh. In 2010, we established a new specific facility for cephalosporin products. Both our plants cater to a domestic CDMO customer, and with our quality product and efficient delivery, we keep on adding new CDMO customers. In 2013, with the receipt of our international GMP certificate, we ventured into export market, and in 2015, we also established Univentis Medical Limited, through which our on-brand marketing operations are undertaken. These new business areas help us to diversify and cater the base for our future growth. Fueled by increased growth, we keep on expanding our manufacturing capabilities. We started a new general block in 2017 and further expanded it in 2021. We are setting up a new manufacturing facility in Jammu. Our company caters to the top 14 out of 15 Indian pharmaceutical companies. We have license to manufacture products through 4 state-of-art manufacturing facilities in Baddi, Himachal Pradesh, Dehradun, Uttarakhand, and Taloja. Manufacturing Taloja, Maharashtra, while maintaining WHO GMP, EU GMP, UK MHRA, and other major registrations with these facilities. With the support of our world-class manufacturing facility and a reliable supply value chain, we are continuously striving to maintain highly efficient operations. The foundation of our company is our in-house R&D, which helps to focus on building complex product portfolio and attract and retain the customer. Our company ranks third among the CDMO peers in terms of formulation manufacturing capacity in India. The company operates in 4 major business areas. 1. CDMO, Contract Development and Manufacturing. Our comprehensive CDMO formulation capability allows us to offer our customer multiple dosage forms, including oral solids, oral liquids, dry syrup, ointment, and injectables. The increased use of outsourcing by pharmaceutical companies has created opportunities to build more strategic relationships with customers. As on 9 months FY24, we have more than 180 CDMO customers. Revenue contributed from this business is nearly 60%. Number 2, domestic branded generic. This business consists of development, manufacturing, and distribution of generic formulation products, which are marketed and distributed in India under our own brand, named through online and offline channels. Our domestic branded generic products are sold through our pan-India network of distribution, stockists and pharmacies. Revenue contribute for this business is nearly 18%. International branded generic. Our international branded generic products business is focused on export to emerging market, while expanding our business to regulated market as well, like United Kingdom and Canada. We had exported our branded generic to more than 20 countries, and we have 189 active registrations, out of which 16 are subject to renewal with international opportunity, and more than 200 fresh registration applications in process with international authorities. We have a strong pipeline of our 41 in process product dossiers for exports. Revenue contribute for this business is nearly 12%. Theron Biomedicine Limited. We acquired Theron on 30th June 2023 through CIRP process. That entity has strong CDMO formulation manufacturing capabilities, including API manufacturing and CRO. With a specific focus on exports, it caters to both domestic as well as international markets, including the mature markets like Canada, UK, Europe, Australia, Korea, Vietnam, and America. Revenue contribute from this business is nearly 11%. Future plan. We are setting up a greenfield plant in Jammu with a project cost of approximately 350 crores. The new project is proposed to have cephalosporin, penicillin, peanut, and BFS blocks to manufacture tablet, capsule, dry powder injectable, dry syrup, and BFS and respiratory rescue products. The facility is proposed to benefit from new central sector scheme for industrial development of J&K. We expect to commence operation by H1 FY25. We keep on aiming to expand our existing business by enhancing our product portfolio with new products and complex doses, bringing new customers on board and expanding our wallet share with existing customers. With continued focus on R&D, we are establishing a new R&D center in Panchkula, Haryana also. We are also looking to expand our business to regulate markets like the UK, Canada by expanding our product range to meet their requirement. Also, the acquisition of Theron, we aim to cater long-term strategy with additional product offerings while supplementing our business value chain. Our current capacity utilization for 9 months FY24 is in range of 45 to 50%, and we will be operating at the optimum level in the coming years. To propel sustainable growth, the company is streaming new growth prospects and heading forward for the value-added products. The Indian pharmaceutical companies are poised to grow significantly in mid to long term as domestic and global manufacturers are looking for a sustainable supplier like us. I now request Mr. Gaurav to take you through the operational and financial performance for the Q3 and 9 months FY24. Over to you, Gaurav.
Thank you. Good afternoon, everyone. Q3 and 9 months FY24 has been a strong quarter for us. All of our key products witnessed healthy demand. In terms of Q3 FY24 highlights, the revenue from operations stood at 302.5 crores, with a growth of about 25% on a year-on-year basis. Business mix was as follows. CDMO contributed about 55% for this quarter. Domestic branded generics contributed 17%. International branded generics came in at 12%, and the balance 16% was contributed by SHAP. Overall exports for the quarter stood at 24% as compared to 10% in the quarter 3 FY23. EBITDA came in at 47 crores with a growth of 27% on a year-on-year basis. EBITDA margins stood at 15.5% for the quarter. Profit after tax for the quarter came in at 25 crores with a growth of 28% on a year-on-year basis. This includes an impact of 1.6 crore of finance costs on account of accounting of CTPS, which was included in the quarter. On a 9-month FY24 basis, the revenue from operations came in at 818.7 crores with a growth of 19.4% on a year-on-year basis. Business mix came in as follows. CDMO contributed 59% for the 9-month period. Domestic branded generics came in at 18%. International branded generics contributed 12%. The balance 11% came in from SHAP. Overall exports for the period stood at 21% as compared to 9% in Q3 FY23. EBITDA for the 9 months came in at 123.2 crores as against 93.4 crores same period last year. EBITDA margins for 9 months FY24 came in at 15%. PAT for 9 months FY24 came in at 65.6 crores with a growth of 29.4% on a year-on-year basis. On the total net proceeds of our IPO of 293.1 crores, we have successfully deployed 231 crores, which is 100% of our FY24 deployment target as of date. With this, I would like to conclude the presentation and open the floor for any question and answers that you may have.
Sure, thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Jagveer Singh from Shade Capital. Please go ahead.
Yes, sir. Thanks for the opportunity. So my first question is related to the CDMO business. In the CDMO business, revenues were down from 687 crore to 680 crore in FY23. So what is this number in the 9 months of CDMO business in absolute terms? Hello?
Could you please repeat the question? I'm not sure we followed the last bit of it.
Yes, CDMO business was down compared to FY22 to FY23, 687 crore to 680 crore. So what are the absolute numbers for 9 months in the CDMO business? Hello?
So the CDMO revenue number for the 9 months this financial year was 484 crores.
400?
484.2 crores.
Okay. So, sir, why this business is going down? Any particular reason?
So, the reason for the, if you understand the way our business operates, for us, we work with our customers on an open costing basis, and the revenues are the cost of the APIs are directly influence the revenues itself. So with the declining API prices, our revenues also can take a downward trajectory. However, our margins remain protected. And this is why, if you see from a margins perspective, we've continued to grow in spite of a decline on the revenue side.
Okay, so what is the expectation for this CDMO business in the next 1 or 2 years?
Yeah. So I think you are looking at our graphics representation of CDMO business that's down from 74 to 59%. So that is the reason for that also, that the Ceron number is being added to our top line number. So more or less, let me have the number, exact numbers, last 9 months and this 9 months. So as the reason was explained by the Gaurav, so last year to this year, the number is bit in a CDMO is flat. The reason that is already explained by the Gaurav. Now, if you look at our manufacturing facility, we have the 3 block in Baddi region. So one block is like a 2006 block, and then the other cephalosporin block we have established in 2010. Then we have the general block that we established in 2017 and expanded in 21. So if we see from our capacity utilization, so out of these 3 blocks, 2 blocks, that is the cephalosporin or 2006 original unit 1 block, is at a higher capacity utilization. So from the capacity point of view, we have a spare capacity in our general block, but we have a capacity constraint in a cephalosporin.
So that we are expanding in Jammu. So most of our growth will come from the Jammu. One reason is that we have the no capacity headroom in the cephalosporin. So that once we establish the cephalosporin again in Jammu, then the revenue will start coming from there. And there more 3 blocks will be there, like a beta-lactam, peanut, and restful and general facility. So number will also flow from there.
Okay, sir. And in the current, excluding Jammu and Kashmir, so at current capacity utilization is 45 to 50%, as you told in the presentation. So, if we exclude the Jammu facilities, what kind of revenue we can do from this at the peak utilization?
So for any manufacturing facility like this, 45-50% is a blended capacity utilization. If you see in detail, then we have like a cephalosporin facility like dry syrup or the dry powder injection capacity utilization at a 70-75%. And in general block, we have like 40%. So blended is 45-50. So now we estimate that a level of 70%, 75% is a good volume utilization. Looking at the seasonal variation, in like a peak season, we can reach up to the 90-95%, and the lean season, like it could be 60-50%. So we have the headroom in our general block for 20-25% capacity still to be fulfilled.
Okay. And so in the Ceron Biomedicine, we did around 192 crore in the FY23.
Mm-hmm.
So at the peak utilization, what kind of revenue we can do from the Ceron, and what kind of margins we can achieve from the Ceron Biomedicine?
So if you look at the Ceron margin profile, it is we have the 45-50% gross conversion margin. And then being in IBC, they also make earlier, before our acquisition, they make like 14-15% of EBITDA only. But after acquisition, we have a lot of synergy, and we see margin improvement there also. So if you see like 192 crore, that is approximately capacity utilization of 50%. So we have the headroom there also for another 100 crore. We can say like to reach at a 70-75 level. And then we can say by improving or debottlenecking the few of the sections, the capacity can also be enhanced.
Okay, sir. And then, so are we planning any capex also in the Ceron Biomedicine in the next 2-3 years?
Not immediate future, but once we reach to say 10-15% capacity utilization will increase, then we'll definitely look into the debottlenecking and or could be like a few section wise expansion, like changing one machine or two machines, or improving the
last question related to the debt. So in the IPO, we raised some money for the debt payment. So what kind of interest rate savings we can see in the FY25?
So Gaurav will explain you. Yeah. Sorry, could you repeat your question, please?
So we raised money in the IPO for the debt repayment. So after the debt repayment, full year basis in the FY25 next year, what kind of interest saving we may have?
So if you look at it, we're looking at currently we should be about, on a full year basis, should be about somewhere in the range of 18 to 20 crores is roughly what you should look at in terms of interest savings coming through for the next year basis. If you look at currently in terms of post the fundraise, right, all our debt has been repaid. The only debt we carry on our books, which is related to the Jammu project, that's a 235 crore debt which we have related to that project. And most of that is getting capitalized as of now. And even once the operator project commences, we will start getting some the concession interest subsidy from the government. So it's 8.5% coupon rate debt, but we have a 6% interest subvention coming in through. So effectively we had a cost of 2%, 2.5% for us. And that's the only debt that will continue on our books going forward.
Okay. So, sir, so we will start this Jammu plant in the next year in FY25. So, if we talk about the FY26, so what will be the interest cost? Roughly any idea in the FY26?
I think FY26 is a bit far out. We would prefer not to give up too much of a guidance on that.
Okay, sir. Thank you very much, sir.
Thank you.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from the line of Dhiresh from White Oak. Please go ahead.
Yeah. So congratulations, Vinay Gaurav, for a good listing, successful listing. My question is on slide number 6. So where you're showing the 9 months revenue, EBITDA, and the segment-wide mix. So in this CDMO, like you explained, because of pass-through of the cost, the revenue is showing a decline of about mid-single digit for 9 months. But from a EBITDA point of view, or let's say from a volume activity point of view, what would have been the growth in that business? Hello, am I audible?
Yes. So you are asking about the volume growth?
No, sir, like we are saying, 5% to earlier question, you explained that 5% degrowth CDMO made because cost pass-through kiya humne, right? Now,
right.
That is because of cost pass-through. But volume growth,
right.
Gross profit growth, EBITDA growth to aaya hoga, right, in that business. So what is that growth?
Right. Okay.
Dinesh, also, I request you to speak a little closer to the mic. We can't hear you very clearly.
Okay. Vinayji, did you get the question or do you want me to repeat?
So can you repeat again, please?
So Vinayji, if you see the CDMO business, like you're explaining 9 months, it is down by 5% in revenue. It is mainly to do with the cost pass-through, right? Because API prices and other prices have come down, right? But our, let's say, contribution profit in that business or volume growth in that business, if you can give some measure of volume activity in that business.
Right.
Or gross profit or EBITDA, whatever measure you have readily with you, if you can give. I'll take it otherwise later if you don't have it right now handy.
So that data is basically not available in hand. Yeah.
Okay, I'll take it later. So my next thing, and also, sure, we'll take it from Gaurav. And Gaurav, excluding Sharon, the EBITDA growth is like 17-18%, right, for 9 months.
So I think just to your previous question, if you want to look, a good proxy for that is also because of standalone numbers, right? There you would look at it as about 7.5% growth, which is on an EBITDA level from a 9-month basis. So in standalone business obviously has the pure CDMO business being the blind share of that business. That's a good proxy for the previous question that you were looking at. And similarly on the EBITDA also, it will give you a similar view.
Okay, understood. And this Jammu plant, if you can just explain, where are we in the construction phase? When do you expect it to commercialize and revenue? Which quarter revenue to show?
So in Jammu, like we have the 4 block that includes cephalosporin, beta-lactam, peanut and general block. So our 2 blocks, that is cephalosporin and general block, is civil is almost completed. Machines are being installed and we are in a finishing phase. So we expect that by the March end we will be ready for validation to start with
for these two blocks. So, and the next two, that beta-lactam and peanut block is just 2 months behind that. Like in Q1, May or June, that physical completion could be there. So we anticipate to start in H1 or late in the Q1 for the commercial production.
Okay. So in the September quarter will be the first full quarter after the full facility is ready, right? Is that fair to say?
Yes. Yeah. So the full
and you
is in the September quarter. Yeah.
September quarter. Okay. And how do you expect the ramp up, sir, of the facility?
Yeah. To clarify before Vinayji answers that question, in terms of the P&L, you'll see the full quarter revenue coming in only from October, November, December, O&D quarter. So that the ramp up will start from the Q3.
Q3, okay. But do you expect, how do you expect the ramp up? Like in the first 6 months, you expect to go to what revenue run rate or what utilization level?
Yeah. So the benefit is here is we have earlier also said that the GST benefit. So we have 12% GST incentive on approximately say sale of 650 crore rupees. So we anticipate a good early ramp up due to this fiscal benefit. As we pass few of the percent point margin to our customer as well. So we anticipate that in Q3 we will have a good ramp up or early start of the revenue.
Okay, understood. Thank you, sir. Taking my question.
Thank you. The next question is from the line of Shubh Jain from Emerge Capital. Please go ahead.
Hello.
Shubh Jain from Emerge Capital. Please go ahead with the question.
Thank you for the opportunity. So just wanted to understand what would be the peak revenue potential for the Jammu facility?
Yeah. So conventionally, if you see that we used to make 5 to 6 times of our invested gross block. So gross block ratio, asset turnover ratio is approximately 5 to 6 times. So here we have invested 350 crore. So the top revenue potential, if we calculate from that data point, so it becomes like 1,800 crore top revenues from that angle.
Okay. And so what is the capex for 9 months ending December?
Nine months capex. We'll give you this number. So we'll need to the numbers not readily available with us. We'll have to pick it out. Will you asking about Jammu?
So the capex number.
Capex number for Jammu, na?
Yes. No, not Jammu. Yes, for the whole company as a whole.
Yeah. So it will be like approximately say 250 crore. The exact number we can provide you, but approximately I think it should be like 250.
Okay. And so what all? Yes. Okay, 250 crores, right?
250 crores. So my number is exact.
Okay. And so what all dosages do we have in the Jammu facility?
Pardon, come again?
What all dosages types we have in the Jammu Jammu facility?
Yeah. So in dosage form, if you see we have the 4 blocks, or we can say it's a 4 factory. So in cephalosporin, we will have tablet, dry syrup, dry powder injection. In beta-lactam, we will have capsule, tablet, dry syrup, and dry powder injection. In peanut, we will have dry syrup, tablet, and dry powder injection. So it's a complete solution for all these 3 categories. Then in general category, we will have 4 Romolag machines. So that will produce water flow injection and rescue product and large volume parenteral, like 100 ml IVs for ofloxacin, metronidazole, ciprofloxacin. Then we have the dry powder injectable facility in general block also. So these are the dosage form that will enhance our existing capability and capacity also.
Okay. And so one last question. Have we started reaching out to potential customers for the Jammu facility?
Yeah, we have already discussed in discussion with our existing customers, and we are getting a very good response from most of the customers that as once we start, we can have the business with them.
Okay, sir. Thank you, sir.
Thank you.
Thank you. The next question is from Ankit Shah from Canara Robeco. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So firstly on the J&K facility, can you give some sense on what kind of fixed cost would come as and when this facility is commercialized, and if any EBITDA level, would we make any kind of losses on what is the impact, some sense on that?
So, earlier, as I commented on the write-up question, that the revenue will be ramped up in Q3, and Q2 will be the quarter where the expense will be there, but the revenue could not be on that level. So we estimate that approximately, including the depreciation also, so our soft running cost will be approximately, say, 2 crore rupees, and then depreciation will be there. So we will try that we get a minimum hit in our P&L, but in Q3 we will be in positive operating margin.
Right. You think for Q2 there will be, for the full quarter there will be around 2 crore kind of cost?
Per month, like 6 crore. Yeah.
Oh, okay. Got it. And second part is that this 5 to 6x peak asset turn, by when can you reach this kind of asset turn? When would peak revenues be reached from the plant?
So generally that take 5 years to reach to that level. So it's like we have observed from 2006 that the number start building with the two reasons. That reason one is that we keep on adding the customer and different market, like in export market, we keep on adding the countries and the registration. And in domestic point of view, we keep adding the customer and then we keep adding the product. So now the story is like we already have the most of the major customer with us. So that is not the issue. The issue is that we need to add the product from the Jammu facility with our existing customers, right? So once we keep adding the product, that have the geometrical effect on our revenue. So like say if in first year we add the 50 products, then in year 2 we add the 100 products. So the existing product will be there and added products keep on growing and then the revenue ramp up.
Got it, sir. And my second question is related to your CDMO performance. So you mentioned that revenue growth is a bit muted because of the cost pass-through. So is the cost pass-through now done? And if I look at the standalone numbers, the gross margin is improving, but revenue growth has been muted YoY. So would the gross margins be stabilized at these levels, or that cost pass-through element is still yet to play out completely?
So this is a mixed impact, and we expect that gross margins will continue to remain, and this could move by a percentage point on the downward trend also. We pass through is mostly been done. We don't, but again, depending on how pricing keeps moving going forward, that will continue to impact our revenues going forward as well. Does that make sense?
Right. So basically, you're saying now that improvement that has happened, that should stabilize now, and depending on the pricing, it will either move up or down.
Yes. So, I mean, if you look at my last year numbers, in terms of the gross margins and then the current year numbers, within that range only, the plus minus of 2 percentage point, that will be impact of product mix that impacts our margins. From a cost perspective, nothing significantly has changed, or pass-through perspective, nothing significantly has changed.
Right. Got it, sir. Yeah, those were my questions, sir. Thank you so much.
Thank you. Participants who wish to ask a question, please press star and 1 on your touchtone telephone. The next question is from Rasmik Oza from 9 Rays Equi Research. Please go ahead.
Thanks for the opportunity, sir. Pardon me if the question is repetitive because I joined the call a little later. Sir, existing plants which you have, not including Jammu, last year they were operating at 45-50% utilization. What is the current utilization for this year, sir?
If you look at slide 16 of the investor presentation, you will see the utilizations have been given for the 9-month period. They remain in similar ranges across for most of the facilities. But in terms of ointments and dry powder injection, you will see we are coming close to the peak. Liquid oils has already peaked out significantly. Sharon is the plants are obviously new additions to us. There's an improvement over last year's numbers, and we continue to work on improving these numbers as we are working on getting in more of business, which was previously not available to them while they were in IBC.
Okay. Thanks for that, sir. And referring to slide 17 also in the same presentation, we have highlighted some potential at optimum utilization. So these two existing plants, Baddi, they are at optimum utilization or full utilization. What kind of potential revenue we can generate and by when can we get this?
Yeah. So as I earlier also explained the call, let me repeat that. So that we have the 3 facilities in Baddi. One is of 2006 and one is of 2010. And then we have the general block of 2017, and we expanded that facility in 2021. So the earlier facility of 2010, there we have the utilization at a higher level. If you see like dry powder injectable in our table, and even the dry syrup, so of cephalosporin dry syrup and dry powder injection at a peak. But whereas in the general block dry syrup or tablet capsule, we have an ample spare capacity that recently expanded in 21. So if you see that the number can ramp up from say 45-50% overall utilization to 70-75% as a peak utilization. So that we have shown in the slide number 70. So if you see like revenue number from Baddi, that come around 1,000 crores. So we have still the room of 300-400 crores revenue ramp up in Baddi facilities.
Okay. So I was just going through last quarter, 2 quarters, your run rate is around 290-300 crores, which gives an annualized figure of 1,200 crores. And from 1,200 crores, if you go to optimum full utilization, can we go to a revenue of around 1,700 crores from these 2 plants, Baddi and Dehradun?
Yeah, yes, you can say that at a peak level, we can easily reach to that level.
Okay.
At a utilization of 65-70%, we can get that number.
Okay. And the next question, sir, you said, it will take 5 to 6x asset turn. You can go to 1,700-1,800 crores of revenue in Jammu over a period of 5 years. But first year will be second half of FY25. So I just want to understand FY26 will be the full first year running operations. What kind of revenue you are expecting in the Jammu plant in FY26?
So like as I say that 5-time asset turn make the 1,800 crore approximately value. So initial we can say like 15 to 20% utilization. So that number could be easily achieved in FY26.
Okay, that is helpful, sir. And the last question, sir, is we were at operating margins of around 12% in FY20 to 23. Now this year we have moved to around 14-15%. Will this be the steady state, or do we see Jammu contributing more or less, or how do you see the operating margins in FY25 and 26 going forward? Because your utilization levels will also go up in the existing 2 plants.
Sure. So if you see our margin evolution, there are 2 things at play. One is we've had Sharon, which is coming into the business, and Sharon as a consolidated is a higher gross margin business, and therefore that is improving our margin profile because it's focused more on the regulated markets. So that is one lever which is helping us grow our margins. Similarly, Jammu will also help us grow our margins because Jammu we have a GST benefit which is coming through to us. We have 12% GST reimbursement coming in there, which means even if 50% of it is retained onto our P&L, that will increase the margin profile for the whole business. And as the mix of the Jammu keeps increasing, the margin will continue to evolve positively.
Okay. So the blended margins in FY26 when you're operating Jammu and a better utilization in the two existing plants, will you be above 15% at the current operating profit margin, or how do you see that?
We would that would be the target we would want to go with.
Okay. That is helpful, sir. That's it from my side. Thank you so much.
Thank you.
Thank you. The next question is from the line of Aditya Sen from Robo Capital. Please go ahead. Aditya Sen from Robo Capital, you may go ahead with the question.
Hi, am I audible now? I was on mute.
Yes, you're audible.
So, in your initial comment, you mentioned that the Jammu branch, the Jammu facility is going to get some benefit from the government. So, what exactly is this benefit? The 12% GST that we just talked about?
So, there are two benefits that are available to us in Jammu. One is essentially the way the notification is of the federal government is that of our total investment in Jammu, we're doing about roughly 350 crore project, out of which there is a qualified plant and machinery definition, which roughly amounts to about 250 crores. 5 times of that is the total GST benefit that is available to us. So that's 3 times that. So that is 750 crores, which is available to us over a period of 10 years. So 75 crore each year. Now, in order to achieve 75 crores, I have to do 75 crores divided by 12%. So about 625 crores of domestic turnover, which I get in the form of reimbursement from the government. Within the first 3 years, carry forward is allowed. Thereafter, it is not allowed. So our target is to achieve that threshold of revenue within 3 years of starting operations in Jammu. And that reimbursement is the benefit we were talking about. And when we said that at least 50% of that we feel confident to be able to retain onto our P&L. Some of it we may need to want to pass to our customers to help with the initial ramp up and attracting new business. The other benefit that I mentioned previously was we have a 6% interest cost subvention available over there. So we have a 235 crore loan which is being used to fund the Jammu project. The coupon rate on that loan is about 8.5%. We get 6% interest subvention. So 2.5% is the effective cost for us on that loan.
Okay, 2.5 is the effective cost. All right. All right, sir. Thank you. That was my question.
Thank you.
Thank you. The next question is from Nitesh Dutt from Burman Capital. Please go ahead.
Hi, thank you for taking my question. I want to understand the thought process behind the Jammu plant in a bit more detail. So as I understand, there are 4 blocks, right? 1 block is common, cephalosporin, and there are 3 new blocks. So 2 questions there. Number 1, is your cephalosporin utilization in the existing Bhakti plant already reaching at saturation levels, and is that the reason you are putting up a new block there? Second, for these 3 new blocks, do we have a visibility on sales in terms of defined customer contracts, etc.? Because these are entirely new kinds of chemistries, new areas for us.
Yeah. So you rightly identified that only we repeating the cephalosporin block from our existing capability. And the 3 new blocks, the new block is identified where we currently do not have any capability and capacity to manufacture all these products. So yes, cephalosporin, if you see, we are at a peak utilization other than capsule. So we are not putting the cephalosporin capsule facility there in the Jammu. We are expanding only the three dosage forms, that is tablet, dry powder injection, and dry spray. So there our utilization is at 75-80%, more than that, even in few like 90%. So that is the reason that we are repeating the cephalosporin block. And then 3 new blocks. So if you see the 3 new blocks, there are the similar products, and we are entering into the BFS category of the products as well. So we already cover 14 out of top 15 pharmaceutical company of India. We have that established relationship with the customer, and we have the track record also. If you see like our historical number in 2017 when we put our general facility, that originally we put the general facility in 2006. Then when we come out with the general block with the added dosage form of liquid oral, we get easy ramp up the sale in the 2 years time. In 2019, we come out with a 200 crore sale, approximately 200 crore sale from this new general block. So that is that we have already experienced that once we put the new facility, new dosage form with the existing established relationship with our customer, we get a good response because of our good infrastructure, up to mark, up to date infrastructure, quality compliance infrastructure. We ramp up the sale.
Got it. And sir, have you sent any trial quantities, etc., or are you planning to send once the 2 blocks are active in March? And how much time will customer approvals and other stuff take? So
yeah,
all kinds of approvals before commercial quantity.
Yeah. So like as we have already have the DSIR approved R&D center. So cephalosporin section is like we already have the established formulation product in our cephalosporin block. So that can be executed through the tech transfer route, and we can easily ramp up the commercial production for cephalosporin. In the other dosage form, we have already established the R&D stage stability and product development. So that is already over. We have developed approximately 25-30 products in that category, like beta-lactam or phenum or in general product or rescue products. So we have already developed that product and established our stability. So once the block is ready, we will start immediately the commercial production in that category also.
Understood.
Also, next part is the customer approval. So that takes like 2 to 3 month time. Once we start the commercial production, they audit our facility, and once the audit is being done, they share the report, and then the business can be started.
Got it. Also for these 3 new facilities, right? As these are new facilities, new chemistries, right, and new products. Can the asset turns and margin profile be different from the existing 5 to 6x and 12 to 15% kind of margin range?
So that we estimated that the blended will be like the same, and the GST will be the add-on.
Got it. Last question on competition. So I want to understand when these pharma companies decide to do more outsourcing and they have multiple options to choose, how exactly does Innova differentiate from other competitors? That's the question.
Yeah. So if you see like the pharmaceutical contract manufacturing conventionally was a fragmented landscape. So there are many small players. We have also started our journey early 2016 in the same category. But with the burden of quality, compliance, and the increase in the cost of plant and operations, there a good player, or you can say more organized, or the revenue is like 500 plus revenue players emerged in the market. So there are like the 5-6 players who have emerged from all these small scale players. And there is a big push from the government as well. Recently the government has revised the Cedulem, that is a good manufacturing practice regulation. So now it is at par with the international standard. And one side, 3 years back, the government come with the regulation that the marketing company will be equally responsible for the product quality. So these are the key factors for consolidating the market from the fragmented industry to the large players. So all the large players will be benefit from these issues.
But within the large players themselves, right? So other players in your league, when a company decides to outsource, how does it decide between an Innova or let's say Akums or any other player?
So say if somebody would like to outsource one product, they come out to their CDMO players. So one is that the availability of product, then the availability of the dossier, the technical data, and then of course the price. Based on that, they take the action that to whom they would like to go.
Got it. Thanks. I'll come back in the queue.
Thank you. The next question is from the line of Jainil Shah from JM Financial. Please go ahead.
Yeah, hi. Thank you for the opportunity. My first question is on cephalosporin. So how much does cephalosporin contribute to our portfolio, and how much incremental peak revenues can Jammu offer over here?
So currently we can say 22% approximately is the revenue for the cephalosporin. And we have the one dry powder injectable line, and we are putting 2 more lines in the Jammu. And our facilities, we have the approval from all ROW countries like Tanzania, Ethiopia, and we are not able to even offer our product for domestic product. So by putting all these 2 lines, we expect a good ramp up there in cephalosporin. So our fair estimation is the 300 or 400 crore revenue could easily be achieved in a cephalosporin in a time span of say 3 to 4 years.
Got it. And how is our current order book looking like, and what kind of visibility do we have in our domestic CDMO segment?
So pardon, come again?
How is the order book looking like? What kind of visibility do we have for the domestic CDMO segment?
So generally we have the confirm order book for say 1.5 months or 2 months next year. And we have the a yearly visibility that the companies generally share yearly plans with us. And based on that plans, they negotiate based on the current API price. They close the order, and generally our order book is approximately 140-150 crores. 1.5 months.
So we're trending at about 300 crores revenue even in 4Q.
So that is this order book I'm telling at Ceron. So say in IPL we do IPL plus UML we do 90 crores. So our order book stand at 150 crores approx.
Okay. And on Sharon, how is our integration going? And have we started exploring any synergistic benefits on the API side?
So if you see in formulation and API both are getting improvement after our integration. We have the common customer as well in formulation. In API also, majorly the API business is based on the export, and there also we have the improvement.
Okay, and just one on capital allocation. We've done Sharon acquisition, we're expanding in Jammu. So, how are we managing, management bandwidth, and what is our capital allocation strategy over the next 2-3 years?
So let's get in terms of let's take the easy one first. In terms of capital allocation, see, as of now, for the next 2-3 years, we have a plan for any new major capex or expansion apart from Jammu. We've maintained that Sharon and Jammu remain a priority for us, but we want to kind of double down on this in terms of getting them scaled
scaled up and running on autopilot over the next 18 months. And that's how we're looking at it. Thereafter, we will look at further other growth strategies, whether it is through acquisition route or through new plants, setting something up. In terms of management bandwidth, I think we're anyways looking to strengthen our management structure, but we don't see any large gaps, either small, middle management hires that we're looking at doing, and which is in part of the normal course. We also, any which ways, have inherited a very strong team through Sharon, which is always running as an independent entity. And the existing business in UML has been run separately by its own management team. So over there also, we're pretty much on track. The key driver for us right now is to look at how we can bring together synergies across the group and multiple, bring some operating synergies at a corporate level to kind of optimize the growth and scale.
Fair enough. And just one last bookkeeping question. Can you call out the one-off expenses probably related to acquisition and IPO that will be there in this particular financial
So, in terms of specific one-off related to, I think just the amount related to the CCPS. So, like I mentioned, there's about 1.6 crore in this quarter and about 8.5 crore on a 9-month basis. That is related to the CCPS. That is at the 1.6 crore sits within finance cost, and in terms of 8.5 crore, the split is, I think, 6 crore is sitting in finance cost, the rest is in other expenses. And there shouldn't be nothing, going forward, none of this would be there, obviously, because the CCPS has been converted within the previous quarter.
Okay. Okay.
Sorry.
Okay. Thank you so much.
Thank you.
Thank you. The next question is from Shubh Jain from Innova Captab. Please go ahead.
So what will be our product mix over the next 3 years, split between CDMO, domestic, international, and Sharon?
So more or less, we see the healthy growth in all of our four verticals at the same pace. So because we will start export business from Jammu as well. So we see like the mix will be the same. There could be the 2-3-4% change in like 60% CDMO could come down to 57 or 62%. But more or less the range should remain the same.
Okay.
And every business is growing its on pace, and the growth rate we also expect the same. Jammu, of course, will be on top of it. Yeah.
Okay. And so what will be a strategy for branded and domestic and international branded generics business?
Domestic? Sorry, could you just repeat that question, please?
So what will be a strategy for the branded generics business?
So, Univenty business. So that is our domestic branded generic business you are asking about?
Yes. Yeah.
So, this year we will have this business approximately, say, 200 crores. And we expect the same growth rate in the future also.
Okay. Thank you, sir.
Yeah.
Thank you very much. Due to time constraints, we'll have to take that as the last question. I would now like to hand the conference back to the management team for closing comments.
Thank you everyone for joining us in the earnings call. We appreciate your time and showing interest in our company. Thank you, JM Financial team, for hosting the earnings call. In case of any queries, you can get in touch with us or SDA, our investor relation advisor. We look forward to meeting all of you over the next call. Thank you. Thank you once again.
Thank you very much. On behalf of JM Financial, that concludes the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.